Good day, fellow investors. Let's start with an analysis of Facebook and try to answer the question you all want to know the answer to, and that is Facebook, now that the stock has dropped significantly, a buy? I've analyzed Facebook in the past. I even bought Facebook, sold, I still own Facebook, and in the past I really estimated that the growth rates will be higher over time, 20% on people using it more, but we have seen in the earnings now that the growth rates aren't there, and therefore when the growth changes, all the valuation changes too, but from growth it can turn into value. For the record, I own 4 shares of Facebook in my large learning portfolio, where I own 20 positions, because I firmly believe that one needs to own a business to really understand it, and therefore if I have interesting risk-reward propositions, I like to own something in this specific large portfolio, small amounts, but I own it and I understand it. And when I see positive risk-reward that I thought was Facebook 4 or 5 months ago, I added it to the portfolio, but with the new earnings, with the new news, we have to relook at the situation, make a new valuation, and make a new risk and reward. And this is also good because it's part of my full analysis of the top 25 positions of the S&P 500. And if you enjoy these analyses, please smash that like button, because it really means a lot for channel support, and consider subscribing if you haven't. You can find all the analysis that we make here in the link in the description below, in the template with the valuation table that is free for you to use and play around and even change your valuations according to your numbers that you think are different. So let's start with the analysis. Of course, after earnings, things have gone really south. Stock crashed more than 30%. It has recently rebounded. I'm filming this on Thursday morning, so I don't know what will happen today. However, this 5% also, there was some positivity in the market, maybe shorts covering. We don't know whether it is a trend and a rebound from this likely oversold position, but if we look at the long term, there have been situations also with Facebook, numerous situations of these big declines and consequence rebounds, and now we have to see whether this is just another decline and Facebook will be able to rebound again, or this time is different. The key numbers to keep in mind is market capitalization $631 billion and price earnings ratio at the moment of 16.85. So let's start with the key factors from the earnings, and one key factor is that Facebook did spend $44 billion on buybacks, so it did reward shareholders, and that's also a number to keep in mind, because $44 billion on $600 billion of market capitalization is a good, let's say, buyback yield that already tends towards value, not more for just a growth stock. And then there is uncertainty, or better to say risk, when it comes to Facebook, because we don't know what will be the returns on the metaverse investments, on the reality labs, and Facebook is really pushing the investments into that field. That is uncertainty or unknown, which means it's a risk. Uncertainty means, okay, I will make a 10% return or 20% return on my investment. That's uncertainty. Risk is I will lose money or I will make money. And that's something you have to see whether you want to take that risk or not. Uncertainty or risk. With the investments, we don't know whether people will flock to it or not. The virtual reality and everything that they are building. That's something to be seen in the future. However, the second factor is, okay, growth, the number of users has stalled, but there is something more important than the number of users, and that's time spent, where your attention is, and consequently, with your attention, with what's going on, there is also regulation, there is also costs, and that's something we have to discuss now. The key is with your attention, and we have seen the number of users, yes, increased 8%, 9%, 5%, 4% over year, stalled in the last quarter. But more important than this is how much time are you spending on Facebook? I personally am spending very little time and much less because I tried Facebook from a creator perspective. It doesn't work. It's terrible compared to YouTube. You're watching this now on YouTube, not on Facebook. And yes, I'm logging in once a week just to answer the messages I get. And unfortunately, most of the messages are, Sven, did you contact me here or there? I think it's a scammer. And unfortunately, there is constantly scammers that I think there have been 1,000 of them that contact everyone that clicked a like or on something on my picture and try to scam them out. And here comes the question of, okay, Facebook, regulation, privacy, and Facebook doesn't care. We report, never got a reply, never nothing. So it really shows that it doesn't care about you. And when something like that happens, you start using it less and less and go somewhere else. And that's from a personal perspective of a user, from both sides, creator and user perspective on Facebook, and that I didn't like, but I said, okay, people are there, people are using it, so growing. I went counter my perception here 4 months ago, of course. However, now I'm seeing, okay, less and less, and plus my wife said about 4 or 5 months ago, so this quarter that we are talking now, she said that Facebook has flooded her platforms with ads. So, and then I'm thinking, okay, if people really started spending less time on Facebook, okay, they will go and check it, birthdays, messages, whatever. But if they use it less, and Facebook has tripled the amounts of impressions it squeezes in the time, maybe they just did it to keep the perception, okay, advertisement is still good, everything is good. But given the increase in ads, I think there has been a severe hit to your attention, to your spent time on the platforms, which creates significant risk for Facebook. Of course, this is an unknown. They've spoken a lot about Reels in the conference call, but Reels, TikTok, Facebook managed to buy Instagram to compete, but will they do it the first time when they are behind, come back and really be the platform where people go to? That's again an unknown. It's not uncertainty they will do it or not. It's really an unknown, which means it is a risk when it comes to investing. Going to valuation, I think the tool to use here and to explain what happened to the stock is the delta of the delta. I explained this when I analyzed Visa as a growth stock more than 2 years ago, but this is the summary of it. So if you have a growth stock, then if the expectation of growth is higher, then the market gives it a higher price-earnings ratio and consequently higher stock price growth. However, if that reverts and the expectation gets lower, there is a double whammy there of a lower price-earnings ratio, to lower earnings, to lower growth, to lower estimation, and the stock crashes significantly. This is the risk of investing in growth stocks, and we have seen the risk materializing here. When things change, things quickly deteriorate with many growth stocks, especially over the last 2 months. And I have expected significant growth here ahead, even used a conservative terminal multiple, and then it fitted my risk and reward. There was certainly risk that I was aware of, so even lower than the current stock price. If the growth rate that I even overestimated here goes down, and then the market puts a lower terminal multiple, and then the present value was still 30–40% down. But then when I said, okay, what's the worst case scenario? Well, the valuation there seemed right for Facebook, but this has changed. So if we take my intrinsic value valuation, I have put here Facebook, and if we click on it, okay, the first things that I missed, I expected earnings of $15.8. The earnings now are 13.6 or 13 point something. You can adjust it in the template later. Then subsequently, the growth rate hasn't been 20%, and given the costs, given the investments, we don't know whether the growth rate will be 20%, will be 10%, or if there will be growth at all ahead. Let's say that growth rate ahead will be 7% over the next 5 years, and then we don't know whether the Reality Labs will deliver growth or not. That is an unknown. So we can put here 20% if that works, or just again 7% if it doesn't work. If we keep the multiple, so just this decline in growth, if we keep the same multiple, it significantly changes the intrinsic value. If things go well, and let's say 7% at the beginning and then 15% on the metaverse, good terminal multiple, then yes, Facebook is still, let's say, a buy, but that's the best case scenario. If they don't manage to go to growth, zero growth, and this is unlikely. If there is zero growth, there will be actually decline in earnings, and then the market gives a bad terminal multiple. This is the potential for Facebook if they don't get traction on the metaverse. So when we change this, let's keep the probabilities as those are, the valuation is significantly lower. If you check what the valuation was here, and then if we adjust for the lower, slower growth ahead, that is the delta of the delta of the delta tool, where there is more factors at play that really hit the valuation. And I'll be doing Amazon on Sunday, and just a comment there when it comes to Amazon. Amazon is also investing 50 billion over the year, Facebook 30 billion, and Amazon is investing in the business that's already there. They need those logistics, those this, or that, where the demand is already there, that you can get the returns immediately, the next year or two. Facebook is investing in something completely out of the blue, and that's also a risk. It's like a venture capitalist investment and not a big growth business with certain cash flows. That's also something to keep in mind. So to summarize the investment, what do we have now? Facebook 2022. We have slowing growth, price-earnings ratio of 16.8, high investments and high regulation costs into something uncertain. Of course, if it works well, the VR, AR, whatever Mark is doing, then they will keep that platform, it will get cool again, it will get interesting if they manage to take away market share from Reels, increase the attention again, then everything will turn around and Facebook can easily double. However, if the attention doesn't get back to Facebook, if people switch to new platforms, which is a key risk with these platforms, then it will get ugly. That is the risk and reward. I wish I knew what will happen, but that's the wrong thing to focus. I know it can happen, good can happen, bad can happen. I just have to see how it fits my risk and reward, how it fits my other covered stocks. This is 20 that I own, plus other 20, 30 that I cover. Compare that, and then at the end of the new earnings, I'll compare again the valuations and see whether Facebook still fits my top 20. It's not even close to my top 5, and that's why I'm not going to add Facebook here, because yes, there is risk and reward, but it hasn't improved. Even if the stock price crashed 30%, my valuation crashed 50%. So the risk and reward hasn't improved. Actually, the risk has increased compared to the reward. Unfortunately, that is how it goes. I certainly overestimated the growth rate last year. Just to conclude here with something we'll discuss next week, Seth Klarman's letter is out, and just to quote him from there, lower valuation stocks, it doesn't mean those are value stocks, because if the underlying business is slowing down, plus the management is splashing cash away on things, high buybacks that they did last year, Reality Labs, and who knows what, then it might not be just a value investment with a margin of safety. So I would say Facebook is medium to high reward and medium to high risk, so not high reward, low risk, which is what value investors strive for. I'm looking forward to your comments. I know there will be plenty of them. That's investing. Thanks for watching, and I'll see you in the next video.